So welcome to today's presentation. My name is Peter, your Senior Market Analyst at IronFX. We will be mixing technicals with fundamentals today. And it's the start of the week, new day, new week. Starting with Euro USD, this is the 4-hour chart. All charts will be presented are to be of the same time frame unless otherwise stated. Now we see that Euro USD has maintained a sideways motion between the 1.0635 and the 1.0460. We tend to maintain the bias for the sideways motion to continue, given also that the RSI indicator has remained close by the reading of 50, implying a rather indecisive market. Also, we note that the Bollinger Bands have narrowed, exactly highlighting the lack of volatility for the pair, which in turn may once again allow for the sideways motion to be maintained. For a bullish outlook, we would require the pair to rise, break the 1.0635, and start aiming for the 1.0770. On the flip side, should the bears take over, would require a lower true than this one, definitely. So the 1.0460 has to be broken, and the pair may start aiming for the 1.0225. At this point, let me add a couple of toolbars, and we'll have a look exactly where the S2 is based on. Unlocking the chart, going back, way back. Okay, practically the S1 is based on these truths here, the S2 on this one. It's pretty wide. However, you can see how this sideways motion had exactly supported an idea of the validity of these two levels, so I'm keeping it. Now, on a more fundamental level, we expect a number of high-impact financial releases to affect the pair in the coming week. And we make a start practically with Germany's preliminary HICP rate for October. That's due out during today's late European session. Small word of warning here. Take notice of the daylight saving time, which has affected already Europe, however, not the US. It's going to be in place, I think, next week. So there may be some confusion about the timing of US releases. Now, financial data, which are to be quite interesting for your traders, would be definitely Germany's preliminary GDP rate, which already came out, Germany's preliminary HICP rate for October. Tomorrow we're getting Eurozone's and France's preliminary HICP rates for October and preliminary GDP rates for Q3. So I would expect that we may see some stagnation regarding growth, which could weaken the euro somewhat. On the flip side, should there be also a slowdown of the HICP rates, we may see the euro weakening further, as that would more or less solidify, or if you prefer, justify the ECB's stance last week to remain on hold and practically foreshadow that rates have reached a level that high that can actually curb inflationary pressures. And once again, my main worries now with the HICP rate slowing down, and should that be verified also in the release today and tomorrow, we may see attention increasingly shifting towards economic activity, an issue which the Eurozone may not be able to avoid, in the sense that we may see a recession. The question is how deep and how prolonged it will be. Once again, for the time being, on a technical level, we tend to maintain our bias for the sideways motion of Euro USD to be maintained. Let's have a look at GBP USD. Also in sideways motion. However, it's nearer to the 1.2065 support line. Now, some of our viewers have suggested the idea that there is maybe a mid-level between the R1 and the S1, something which could be the case. Let's have a look at it. Give me a sec. So the level was suggested to be here on this peak here. You can see how it was tested here and here and here as well. How it was breached a couple of times. Let me drill it into red. That would be a mid-level at 1.2215. Let's round it a little bit. Yep. That would be a valid point, yes. On the other hand, though, I would still require for a bullish outlook a clear break of this one, of this peak here. So practically, in my point of view, the 1.2325 has to be broken for a signal, a clear signal that the bulls have started to take over. On the other hand, for a bearish outlook, I would require the pair to break the 1.2065 level, which was tested here and here, and start aiming for the 1.1925. On a more fundamental level, I would be highlighting BOE's interest rate decision. The bank on Friday was marginally expected to remain on hold. Now, there are a number of elements here which come into play. The first is that despite some hits, the UK employment market remains rather solid. The employment rate is pretty low still. I would note that inflationary pressures in the UK economy may be slowing down, but may not be slowing down at the pace that BOE is wishing for, and definitely are far higher than BOE's inflation target of 2%. So that would be feeding the hawks within the BOE. That's one. On the other hand, BOE Governor Andrew Bailey seems keen to remain on hold here. And let's not forget that the majority which decided the on hold position in the last meeting was only marginal. It was 5-4. So practically any shift from the hawks to the doves, or practically from on hold to hike, even by one, would shift the bank stance. For the time being, though, I do see the case for the bank to remain on hold, yet in its accompanying statement and possibly BOE Governor Bailey's comments or statements, there will be a clear, decisive hawkish tone. On the one hand, the fact that the bank remains on hold may weaken the pound. On the flip side, a hawkish tone may ease any bearish tendencies of the pound. It's going to be interesting to see how that is going to be unfolding. At this point, I would expect that pound traders may have a relatively easygoing week ahead. You have no major financial releases. Okay, some are pointing out the final PMI figures. In my opinion, usually the preliminary releases tend to draw most of the market's reaction. I would also be noting the nationwide house prices could be of interest. But overall, I think that pound traders will be more focused on BOE's interest rate decision this week. Okay, let's have a look now at USD/JPY. USD/JPY, which has corrected lower and stabilized. A very interesting move. Let me readjust just a bit the labels so we get a clearer picture here. And I'm highlighting here that we have pretty narrow distances between the support and resistance lines. So there was a breaking for a brief period of the 150 resistance line. However, I wouldn't say the reactions, I would say the statements which were issued by the Japanese government, and I would be highlighting here Japan's Finance Minister Suzuki, who actually warned against shorting the yen and actually mentioned that the Japanese government is watching FX moves with a great sense of urgency, the usual mantra, but at the same time did not actually mention that the Japanese government could intervene, but it's still a possibility if USD/JPY remained above 150. For now, I think that JPY traders are going to be increasingly shifting their attention towards BOJ's interest rate decision. That's due tomorrow during the Asian session. Now, on the one hand, USD/JPY is still, despite the correction lower, at relatively high levels, implying a relative weakness of the Japanese currency. And that weakness has made it an easy target for short sellers. I would be highlighting here that BOJ's ultra loose monetary policy settings are practically weighing on JPY, given that interest rate differentials, say between BOJ and other central banks, but also on the bond market, may diverge against the JPY. So practically carry trading here may find its place. And actually that may be weakening JPY over the past months. It's characteristic if we drill out to the daily chart, allow me to show that. See how much practically JPY has weakened over the past 7 months. That should be since mid-March 2023. It's very characteristic. We were talking about levels of 130. Now we're talking about levels of 150. Back to the forward chart. We're adjusting it once again. So what will BOJ be doing tomorrow? Okay, my guess is as good as anybody's, but at this point, the interest level is not to be a question. The bank will remain most probably on hold at minus 0.10%, yet may want to send a rather hawkish signals to the markets in order to further support JPY. And if it wants to do that, most probably it will be raising the tolerance level of the yield curve control, yield controlled curve. And we may see the tolerance level on 10-year Japanese government bonds be risen, could be by 50, could be by 25 basis points, and definitely above 1%. And such a move could actually allow the bank to intervene in the markets in a more freely manner. So actually that would, I would say, allow yields to rise even further, practically increasing the attractiveness of Japanese yen. On the other hand, though, may not be taken as seriously given that everything else remains relatively unchanged. So it's going to be interesting to see if the bank will be actually trying to send such signals outside in the markets or not. Should that be the case, I would expect JPY to strengthen, and that would lead USD/JPY lower. On the other hand, the bank may opt to remain, or if you prefer, keep its monetary policy settings unchanged. And such a development, in my opinion, would weaken JPY. And that would allow USD/JPY in turn to rise above 150 once again. However, at this point, I would be noting that should USD/JPY weaken after BOJ's interest rate decision once again, regardless of the content of the decision, I would expect that most probably Japanese government will be intervening in the markets at some point later. It's, in my opinion, the last window of opportunity would be exactly BOJ's interest rate decision. If that fails to actually strengthen JPY, we may see a market intervention here. Let's have a look at AUD/USD. AUD/USD, which remains in a sideways motion. And I think that's pretty clear with the R1 0.64 being the upper boundary of the current sideways motion. Okay, there was a break above it, but nevertheless we can see that the level was defended once, aimed for here twice. So in my opinion, that's still pretty valid, while it had also some support qualities. To the downside, we note the S1, 0.6285, tested here, and breached briefly here. But that was very, very brief breach, not even for 12 hours here. And the pair quickly re-entered the corridor formed between the 0.64 and the 0.6285. I would expect the sideways motion to be maintained for now, yet a small word of caution here. The RSI indicator has risen a little bit and has reached the reading of 58. Could be an indication for a slight buildup of bullish tendencies. Should such bullish tendencies actually be reflected on the price action as such, now for bullish outlook, we would require definitely a clear break of the R1 0.64, not just to break it and remain slightly above it like it was here, but to break it and start aiming for the 0.6510. That would allow us also to draw a nice upward trend line showing us any limitations of a possible upward movement. On the flip side, should the bears take over, then I would require the pair to drop, clearly break the 0.6285, and start aiming for the 0.6165. Okay, let's have a look at USD CAD. USD CAD, which in contrast to AUD USD is moving now in a clear upward direction. And we have to note here that the slope of the upward movement has intensified. However, that's being put to the test within today's, I wouldn't say European, maybe in the American session. For the time being, though, we definitely have to switch the role of the 1.3785 into support line. And let's go hunting for a new ultimate resistance line. Unlocking the chart, going back. Nope. Let's drill to the daily chart. Nope, daily. This level seems to be providing resistance a couple of times. I'm going to be keeping it right here. And that would be in red. I know it's a little bit wider than the rest. And that would be 1.4115. Locking it in. Readjusting the chart. Back to the forward chart. Okay, let's correct those to the content of the label, starting with the S3 at 1.36. S2 at 1.37. S1 at 1.3785. R1 at 1.3885, 100 pips higher. R2 at 1.3975, 90 pips higher. And the R3 at 1.4115, which is over 140 pips higher. Locking it in. Now we have some contradicting signals, maybe. Okay, definitely we tend to maintain an upward movement bias, i.e. a bullish outlook for the pair. And that's going to be valid as long as the upward trend line guiding the pair, you can see it right here, and especially its upward slope, its steepened upward slope, has practically, or if you prefer, remains intact. At this point, the idea of a bullish outlook is also supported by the fact that, okay, definitely this one has provided support at 1.3785, proving its worth as a support line as well. But also I would be noting here that all three moving averages, the 20 moving average, here you can see it in blue, the 50 moving average in green, and the 100 moving average in orange are pointing upwards, exactly highlighting the bullishness of the past movements. On the other hand, though, I would be noting some worries about the RSI indicator, which, okay, it still is at levels between 50 and 70. It's actually at 62, which is not so bad for the bulls, actually. But the fact is that it has declined. It had reached the reading of 71.5 and has dropped to 62. So there may be some easing of the bullish sentiment of the market, which may allow at some point USD CAD to stabilize somewhat should it continue. In that case, we may see the RSI indicator nearing more the reading of 50. And I expect that at that point, or maybe even earlier, we may see the price action of USD CAD actually breaching the pre-mentioned upward trend line, in a sense that the upward movement has been interrupted. And that would allow us to switch initially our bullish outlook in favor of a sideways motion bias between the 1.3885 resistance line and the 1.3785 support line. So it would be a movement like this in the middle. Give me a sec. Yep. So for a bearish outlook, I would expect the price action to drop, break the pre-mentioned upward trend line, once again highlighting the interruption of the upward movement. But for a bearish outlook, I would also require the pair to break the 1.3785 and start aiming for the 1.37, if not even reach it. While, as we have mentioned, the base scenario is a bullish outlook, and in that case, I would expect the price action to rise, breach the 1.3885 and start aiming, if not reaching, the 1.3975. At this point, it would be interesting to note that we may see the pair rising, bouncing on the upward trend line and rising, yet remaining below the R1. That would be, in my opinion, a warning for possible sideways movement, as the price action seems to be hitting, in such a case, a ceiling at the R1. And for a continuous upward movement, we would require higher peaks and higher troughs. So should there be no higher peak than the previous one, practically a break of the R1 1.3885, the bullish outlook may be endangered. Let's have a look at WTI, which, if I'm correct, has been dropping. No, it has stabilized. Sorry. Let's also readjust the levels. So we see a price action which has more or less been rotating around the 84.50 level, and that's over the past 1 week, more or less. Yeah. The idea of a sideways motion seems to be maintained, and that's being evident practically by three factors. A, we have a flattening out of the 20 moving average. B, note how the Bollinger Bands have narrowed, implying lower volatility, which could exactly allow the commodity's price to maintain a sideways motion. But also note how the RSI indicator is running along the reading of 50, implying more or less, I would say, a rather indecisive market. The problem here is that, on the one hand, the market seems to have priced in the possibility of actually Venezuela flooding the markets with oil on a fundamental level. And that may have caused the drop which we saw in the past week, the week before, sorry. On the other hand, my worries remain about the Israeli conflict. And should the conflict actually escalate with participation of other forces, that could more or less intensify market worries for the supply side of the commodity, and once again push oil prices higher. In this case, it would definitely break above the 84.50, possibly even the 87, and start aiming for the 90.40 level, which was reached here. On the other hand, should the bears regain control, as they did here, we may see the price action dropping, breaking this 181.70. That would be a prerequisite. That would require a lower trough than this one or this one. So the price action has to break below the S1 and start aiming for the S2 77.50. Okay, let's have a look now at gold's price. Gold's price, which continued dropping. And at this point, allow me to sorry, that would be Nasdaq. My mistake. Let's move now to gold's price once again. Here it is. I was quite shocked when I saw the chart. I said, I can't be good. And it isn't. Now, gold's price has been on the rise once again. And I would say that we may be talking about a new upward trend line. Allow me to draw it, albeit some may even discuss this as an upward trend line. In my opinion, that's not correct. We have a new upward trend line, as practically the price action had stabilized here. And allow me to show that. So you can see that there was a relative stabilization here of the price action for the precious metal. And now we have a renewed upward movement, which started like here. And it has breached the upper boundary of the past sideways motion. You can see how we have consecutive higher troughs and higher peaks. And I think that would be more obvious in the daily chart. Allow me. Here it is. So for the time being, we tend to maintain a bias for this upward motion to be maintained. But before we discuss any further the direction, allow me to switch the R1 to the S1, given that the price action has breached it clearly, and start. Let's go hunting for a new ultimate resistance line for gold's price. If there is any. There's one. And I would be narrowing this one here. That's better. And at this point, I would like to recalibrate practically gold's resistance support lines. Okay, the R1 and the S1 remain. The S2 also tends to remain. And the S3. Back to the forward chart. Readjusting. Starting with the R3 at 2077. The R2 at 2050. Now I would like to set a new R1, and that's going to be based on the latest peak here at 2008. The S1 remains unchanged at 1975. The S2 at 1932. And the S3 at 1900. Once again, for the time being, we tend to maintain our bias for the sideways motion to continue. Allow me to, Once again, we tend to maintain our bias for the bullish outlook to be maintained. In that case, I would expect the price action of gold to actually breach above the 2008 resistance line, which marks the last peak. and start aiming for the 2050 resistance level. On the other hand, should there be a stabilization of the precious metals price, we may see the price action practically breaking the prementioned upward trend line. And in that case, I would expect the precious metals price to remain above the S1 1975. That would allow gold's price to remain in the spectrum between the R1 and the S1. That's a pretty tight range-bound movement. Should the bears take over, once again, I would expect the price action to breach the pre-mentioned upward trend line, but also breach the S1 1975 and start aiming for the 1932. The RSI indicator has eased and has dropped to a reading of 58, which may place some difficulties for the bulls to advance any higher. But if we drill to the daily chart, it's a different picture. There's still an upward movement here, which is clear. And it's impressive how gold's price has rallied practically since the 10th of October. Okay, back to the forward chart. Let's have a look also at the US stock market index. I would be preferring here Dow Jones. Note how there is a clear downward motion. This is the daily chart, by the way. We have to mention that. And it has breached below the 32,885. That was on Friday, which was even the high point. Yet I would like to show something which is of interest in the following sense. Okay, here we have a clear downward movement. That's clear. Let's drill into the US 100, that would be NASDAQ. Note how there is relative stabilization, but let's not compare apples with oranges here. Daily chart again. There's still a downward motion, but there is a difference in the past two sessions. In Friday's session, NASDAQ remained unchanged, opened with a positive gap, and is on the rise today. If we have a look at Dow Jones, then you can see a wide drop on Friday and a slight correction during today's session. So there is a difference here which is not negligible. Back to the forward chart. This is once again NASDAQ. Okay, definitely the S1 has to be changed in to the R1, given that it has broken and actually solidified below it. Let's go hunting for a new ultimate support line. This is an interesting level. Okay, one level could be set here. There was a level which it had actually breached, or if you prefer, reversed the intense downward motion. But I'm interested also in this level, which used to be a resistance line, but also a support line. And that was the platform at which practically NASDAQ stood and started to rise. So in my opinion, that's a pretty valid point. In green, 13,430. Readjusting. Let's correct also the labels. $15,525, 14,790, 14,430. S1 being placed now at 14,085. S2 at 13,770. and the S3 at 13,430. We tend to maintain a bias for the downward motion to be maintained, yet I am highlighting here the stabilization of the index. And that's not irrelevant to the fact that the RSI indicator has risen above the reading of 50 and is nearing the reading of, it has risen above the reading of 30 and is nearing the reading of 50. It's actually right now at 43.6, more or less implying that the bearish sentiment is fading away, which could allow the price action to stabilize somewhat between the S1 and the R1 and challenge the downward trend line. It's going to be an interesting American session today. And at this point, I would expect that US stock markets may continue to be led by earnings reports, but also at this point, I would start worrying about deeper fundamental issues. It's not by accident that over the past 4 or 5 days, there has been increased discussion about the level of the US national debt and how that may be sustainable or not. It's a big question in the US. And may I add here that the issue may also be fueled by political incentives, given that in a couple of weeks we have the new deadline where practically the US government is going to be asking US Congress for an expansion of the debt ceiling. May I remind you guys how difficult the negotiations were in the last decision in Congress, where practically far-right Republicans were about to not allow the US government to increase its debt and were even willing to allow the US government to default. So that's a big issue here and may create some additional bearish tendencies for US stock markets. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Hello everyone! The term risk-off refers to the mood of traders and investors in the financial market when they want to avoid risk exposure and safeguard their funds. When traders are pessimistic about the economic outlook, they tend to sell risky assets and buy safe haven assets. In such an environment, safe haven assets like the Japanese yen and gold tend to gain in value, while high-risk assets like stocks and commodities tend to decline. Markets are frequently labeled as risk-on or risk-off. Both of them express global market sentiment. Risk-on, risk-off is frequently abbreviated as RORO. This happens when price behavior is driven by investors and traders' changes in their risk tolerance. When traders are not optimistic, then they tend to reduce leverage, selling risky assets and buying safer assets or even preferring cash. US Treasuries and German bonds are considered almost risk-free. The US dollar, Japanese yen and the Swiss franc are safe havens and tend to rally when traders want safety during times of uncertainty. The price of gold usually increases and the yield on government bonds falls. Thank you so much for watching us today, guys. Stay tuned. Bye-bye.
Before we get started, as per usual, a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so maybe just a brief introduction. I am Melanie and I will be your speaker for today's stop loss strategy webinar. Okay, let's go ahead and get started. So here's our agenda for today. Firstly, we'll talk a bit about how stop loss will affect your risk to reward ratio beyond and before. So if you're wondering what that is, we'll get into that in a little bit. And then how far should your stop loss be, market structure stop loss, Fibonacci stop loss, and then we'll go through a couple of trailing stop loss strategies as well. Okay, but first things first, we'll go through the anatomy of a trade as well as some risk management strategies. So trade management refers to the process of managing open trades in the financial markets to maximize returns and minimize risk. So, of course, the anatomy of a trade contains or consists of the entry, your stop loss orders, as well as your stop profit or take profit orders. And then this is what is part of a risk management series, which we won't go through in detail today. Maybe in future webinars we'll go through these, but for today we're going to focus purely on stop loss, and we'll touch a little bit on trailing stop loss as well. Okay, so firstly, why is it so important to have a trade management strategy? So firstly is to control risk. Trade management strategies such as stop loss orders and position sizing helps traders to limit their potential losses as well as manage their overall risk exposure. Next, maximize profits. So trade management strategies such as take profit orders and trailing stops help traders to lock in your profits and maximize returns. Manage emotions. This is pretty important because the discipline and structure that having a good risk management strategy provides can help traders to stay calm and rational even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Fourth, improve trade efficiency. So when you have a well-defined trade management plan, then you can make faster and more informed decisions and avoid the cost and time of having to constantly monitor and adjust your positions. And lastly, increase consistency. So an effective trade management strategy and risk management techniques helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of winning trades. Okay, so let's get into it. So although we're focusing purely on stop losses for today, I do want to touch a little bit on take profit as well. So we'll start off by going through the issue of having a fixed take profit and stop loss. Okay, so we're going to start off with take profit. So let's take a look at this example together. So the red area here shows a strong resistance area because this has two multiple swing highs that line up nicely. So if our trading strategy requires us to have a fixed take profit of 100 pips, then we will place the target beyond this strong resistance area, which you can see here. That's what we did here. Okay, so let's see how this plays out. And you can see that price shot up, but it missed it by a couple of pips before reversing back down. And the reason for this is because price tends to reverse off of big areas of resistance and support. So it might not reach where you place your take profit. Okay, so here we see in an alternative scenario, if we had placed our take profit before the key resistance level, which means just slightly below, we would have got a profitable trade because price would have been nicely touching our take profit. So it's important to look at the charts and then adjust your take profit and stop loss accordingly. So the lesson that we're trying to talk about in this case is to not blindly follow a fixed take profit target just because some forum or education platform tells you to do so. Because you always want to look at your charts and adjust accordingly because each chart is different. Okay, so this is the general idea for stop loss and take profit placement. So this is what we meant earlier by beyond and before. So for a stop loss, we would typically recommend you to place it beyond a major resistance area. So if we're talking about a major support area, this should be support instead of resistance. So if we're talking about a major support area or even a major confluence area using Fibonacci, you want to place your stop loss below it or beyond it. Below would be if it is a support level. And you can see in this case, since it's a resistance area, we'll place it above. So that's what we mean by beyond. So for our take profit, on the other hand, we want to make sure that we place it before. So that means that it's within the charts. So not beyond it, before it. And if we're talking about a major resistance area, then we will want our take profit to be placed just beneath it. Okay, so this is the general idea for a proper stop loss and take profit placement to ensure that you maximize your wins as well as minimize your losses. Okay, we'll go through a couple more examples in the next few slides as well. Okay, sorry about the mess over here, but this is just to recap a little bit about the whole stop loss beyond take profit before concept, but in the context of Fibonacci confluence. So in this case, we're talking about Fib confluence. So stop loss beyond still stays, and you want to place it beyond a key Fibonacci confluence area. So price is attracted to strong areas of Fibonacci confluence. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the most common reasons why people wonder why they got stopped out right when the market starts to reverse. So if we talk about take profit, we mentioned earlier we place it before a key Fibonacci confluence area or major resistance area, so on and so forth. And the reason for this is because when price reaches the Fibonacci confluence area, there is a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. So this is one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, so that's the general idea of trade management and where is the proper placement for stop loss as well as your take profit levels. Okay. Here in this case, we are talking about the problem with fixed stop loss. So earlier we talked about the problem with fixed take profit. So now we're talking about stop loss. So here's an example to show this problem. Here we have a support level. You can see two swing lows that line up nicely at this support level. Price has bounced off of this support level, and we are expecting it to continue to rise to the swing high resistance over here at the 1931.43. Okay, so our stop loss of 100 pips is fixed at this 1894.75 level at the support level. Okay, so this is what happens instead. Instead of shooting up as we expected it to, it actually reversed off of our entry and then bounced off perfectly. So what we should have done instead was to place our stop loss, which was over here, the green line. Instead of the green line, we should have placed it at the yellow line instead, because we mentioned earlier that you want to place your stop loss slightly beyond a key level of support or resistance, just to allow that space for a reversal or a bounce to take place. Okay, and we can expect this to happen because price often gets attracted to key levels of support or resistance and then reverses off of them. Okay, so now we're going to talk a bit about dynamic stop loss placement. So that's what we talked about in the previous few slides, is precisely why dynamic stop loss placement is so important. So if you're wondering what exactly is a dynamic stop loss, it's a trading strategy used to manage risk in which the stop loss level is adjusted dynamically based on market conditions. So the level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. So the goal of a dynamic stop loss is to lock in profits while minimizing potential losses. So the placement of the stop loss can be determined by various technical analysis indicators or other market conditions, such as volatility or market trend. So here is our first example. It's to demonstrate dynamic stop loss. Here we have price bouncing nicely off of the support level at 86.721. So it's bouncing off here. We're expecting it to reverse off the entry at this 87.819. That's in line with this 100% Fibonacci projection level. Okay, and then our stop loss is placed at this swing high resistance here. So this is what happens. We're expecting it to reverse off. So it does test this level, this entry level. And the reason for this, for that bit of resistance, extra resistance at the entry, is because you can see earlier we have this 100% Fibonacci projection that lines up nicely with this level. So you can see the resistance and price testing this entry. Next, we have the negative 27.2% Fibonacci expansion, as well as the 61.8 Fibonacci projection that line up nicely. So this is where we decided to place our stop loss. And this is how we use Fibonacci levels as stop losses as well. When you have a couple of levels that line up nicely, we call that a confluence area. And it's even better if you can find a chart indicator or market structure indicator, where basically you look at the chart and you see that, oh, this is a resistance level, and we place a stop loss here. And this stop loss lines up nicely with Fibonacci levels as well, which makes it extra important to take note of. So we see price is testing the 87.819 level at the entry here. So we mentioned earlier that stop loss should be placed beyond the Fibonacci confluence area instead of directly on the area. And we'll show you why in the next slide. So this is a zoomed out version of what we had in the previous slide, but you can see price breaks out of our entry and it hits right towards our stop loss levels. And it's just as we had expected, because this is, as we mentioned earlier, that this area is an important area with the Fibonacci confluence as well as the swing high resistance. So this whole area is a strong area, and its price is attracted to such strong areas of resistance. So we can expect price to be attracted to this area. So what we do is we place our stop loss beyond it. And you can see if I place my stop loss directly on this Fibonacci area instead of beyond it, we would have gotten stopped out. So we're expecting the reversal, and it hits right down to our take profit, which is exactly what it did here. Okay, let me know in the chat if there are any questions throughout the webinar. But I think so far we should be pretty clear on this. So let's take a look at another example. In this case, we have another take profit placement example. So here we're expecting price to bounce off of our entry at the 87.625 level at the pullback. So this is what we call a pullback resistance, because we have a swing low here and price has passed this area here. So before price actually reverses off this area, it's called a pullback, because we are expecting price to pull back to that level or retrace to that level. Okay, so our stop loss is placed at the swing high resistance here, and our take profit is placed at the swing low resistance. And then if we take a look at our Fibonacci, we have the 78.6% Fibonacci retracement that lines up nicely with our entry level. So once again, this is a level for us to take note of. We can expect price to be attracted to this level here. Okay, you can see price moving up this area. Price hit our entry and has reversed off of it nicely. It's now heading towards our take profit. And then we pull out another Fibonacci indicator. In this case, we are using Fibonacci retracement. Okay, this is wrong. It should be 50 Fibonacci projection, because this is our starting point, our middle point, and our ending point. So this is a 78.6% Fibonacci projection. Sorry about that. But the chart is still correct. We have a projection level that lines up nicely with our take profit. So you can see we're expecting price to be attracted to this area because of the swing low resistance, swing low support, as well as this Fibonacci level. So you can see price was attracted to this area. It approached it continued downwards to our take profit, and it touched our take profit just nicely before reversing off of it. So this is one reason why we advise you to place your take profit before it, because if you had placed it even slightly below, you would not have caught this take profit there. Okay, actually, even this take profit level is a little bit far, so you have placed it further in on our price chart. Okay, next example, we're looking at a take profit placement again. So even though this is stop loss, but we want to talk about take profit to show you guys how the two line up nicely together. Because even if you have mastered all of the stop loss strategies, if you can't manage to get your trade in a take profit, there's no point to it basically. So here we have firstly a descending trend line, but you can see our price has recently broken out of this descending trend line. So it's giving us a bullish bias. Okay, so after we've established that, we go in with our take profit and stop loss levels, and these we make use of the support and resistance levels here. So our entry is at this pretty significant level, overlap resistance. Overlap just basically means that a bunch of swing lows also line up nicely with a bunch of swing highs, and price has tested this level many times. Then our stop loss level is just at the swing low here, and our take profit is in line with many Fibonacci levels that you can see here. So it's a negative 27.2% Fibonacci expansion, as well as a 127.2% Fibonacci extension. So with these two lining up at our take profit level, remember you want to place your take profit before instead of beyond your Fibonacci levels. Okay, in this case, you see we placed it above or before it, or beyond it, I mean. And you can see price reversed off of it and we missed our take profit by a few pips. So if we had placed it below instead, it would have nicely hit our take profit before reversing back down to our entry. Okay, so now let's get into the trailing stop loss. So a trailing stop loss is a special type of trade order that moves relative to price fluctuations. So when the price goes up, it will drag the trailing stop loss along with it, but when the price stops going up, the stop loss price remains at the level that it was dragged to. So it's an order type that's designed to lock in profits or limit losses as long as the trade moves favorably. So an automatic trailing stop loss moves according to how price moves favorably, and then a manual trailing stop loss is a moving stop loss level that's based on mechanical indicators. So here's an example of where you place an idea invalidation level. Okay, so here's our first level. This is moving average. Here we have the chandelier SAR. Here with the ATR is parabolic ATR as well. Okay, so here is how to use them. Okay, in this case, we are using moving average as our first example. So here we are going in for a sell entry. You can see I've indicated this level where we want to enter from is a 1.57891 level. Okay, and this is where price crosses the moving average indicator, and that's my entry. Also note this ascending trend line as well, and price is breaking out of it. So a lot of bearish indicators over here. Okay, so price, or rather we call this a moving average crossover. So once price crosses over price, then we go in for the entry. Price continues moving downwards, and then once price crosses over the moving average again, then our trailing stop loss is triggered. Okay, so it got us out before this happened. So this is the before, this is where you get stopped out. And then this is what happens if you weren't stopped out. Okay. Here we have trendline trailing stop loss. Remember, for a valid trendline, you need at least 3 touches for it to be valid. Here we have 1, 2, 3 over here. Okay, so the same concept on the same chart, we have this trend line with price moving downwards, and once price starts reversing, even though it's reversing, we are not stopped out yet until it hits the trend line, and then we are stopped out. Once again, to prevent us from this eventual upward movement. Okay, so here we have parabolic SAR, trailing stop loss. It's the same concept. We are going in for a sell entry once price changes, or rather once our indicator changes. So it's moving downwards, and then once price hits our parabolic SAR indicator, that's a sign for us to be stopped out. So yeah, that's how the parabolic SAR trailing stop loss works. Okay. Here we have chandelier and ATR trailing stop loss. So it's all on the same chart, just to show you guys how you can use the different indicators as your trailing stop loss, just to help you guys decide when to stop or get out of the trade. So same thing, same sell entry, same chart. So we go in for the sell over here. Once price moves downwards and it hits our indicator once again, then both of these indicators are triggered and you have gotten out of the trade. So it really minimizes your losses that could have resulted if you had allowed price to continue moving upwards. Okay. So here, how we know this is our sell entry, using these two indicators. Basically, when price overlaps over here, as you can see over here, there's another overlap that takes place, and that's why you get stopped out. Okay. So here is an actual example. Here we have the Kiwi dollar, and we are making use of the moving average indicator. So we go in for the sell entry over here when price okay, firstly, we have this ascending trend line. So it's moving upwards. And then we go in for a sell entry once price starts moving down. So it hits this ascending trend line as our sign that it's gonna break out of the ascending trend line. Going for the sell entry, we continue, and it hits our take profit. Okay, another indicator is that over here, at this green line that I've indicated here, you can see price cross over our indicator. So that's yet another sign that price is gonna continue downwards, or trend is going to change. Okay. Next example, we have once again a trend line. So trend line going upwards, price breaking out of it, then we go in for our sell entry. So going for our sell entry all the way, we're expecting it to move all the way downwards to our take profit. Okay, so the red and the blue lines, as you can see here, the lines that are not indicated as stop loss, sell entry, and take profit, these are the lines that we are showing you are pretty significant because we have an overlap resistance here. So as I mentioned earlier, an overlap is a swing high and a swing low that line up in the same level. So that's our red line. So remember I mentioned that when we have significant areas of resistance, that we want to place our stop loss beyond it. So that's exactly what we did here. And then as for our take profit, over here, I have a big swing low over here. So which is why I place my take profit before it instead of below it over here. Okay. So that's the end of our slides. Now we're going to look at some charts and see if we can implement what we've just learned into actual setups. So let me know in the chats if there are any specific setups that you'd like to see. I think you should be able to let me know in the chat or let me know in the Q&A section. Yeah. Okay, I think in the meantime, let's go ahead and just take a look at maybe euro dollar. Okay, if there is any other commodity or currency pair you'd like to see, feel free to let me know in the chat. Okay, so let's get right into it. So we typically like to start on the higher time frames and then work our way down. So here I have on the weekly time frame, we have a pretty bullish, I mean, it looks like price is moving upwards, the general direction. Okay, on our daily as well, we have a ascending trend line. Okay. So both weekly and daily timeframes are giving us pretty bullish trends. Now let's take a look at our 4-hour time frame. Okay, it does look like price is breaking out of the ascending trend line here. Okay, but let's go in with some support and resistance levels. So here's my first resistance, and then my second resistance over here. My first support just here. And my second support here. Okay. So now that we have that, let's go in with our Fibonacci levels. So from here to here, I have a retracement. You can see my 50% retracement lines up, and my okay, even though this 50% lines up nicely with my first resistance, it's no longer valid because you can see price has already broken out of this level. So I'm gonna look at the other levels. For retracement, we use these 5 levels: 23.6, 30.2, 50%, 61.8, and 70.6. Okay, and I can see that my 78.6 lines up nicely with my second support. So I'll just keep that. Okay, now let's go in with a Fibonacci projection. Okay, I can see that my 61.8 and my 100% line up nicely. Okay, I think that's all the levels that I have. So now I'm going to go in with some indicators. So the indicators that we like to use are Ichimoku and MACD, because just at one glance, it tells you exactly what the signals are. So price is moving below the Ichimoku cloud on our indicator, giving us a bearish signal. MACD is giving us a pretty bullish signal. Slightly bullish over here. Let's take a look at RSI. Okay, we have this bullish signal. If we take a look at our chart, at our price chart versus our RSI, at the highlighted areas, price has remained at the same level at our first support, whereas on our RSI, it has made a higher high, and in fact, price is moving in this ascending trend line on our RSI. Okay, so I'm gonna go ahead and remove this trend line here because earlier I mentioned that it could be breaking out of the descending trend line, right? But it also could be an ascending trend line. So this is one of those rare occasions where we have 3 touches on the trend line for both, depending on how you adjust it. Okay, so that's why I waited for all of my other indicators as well as my analysis to be completed before I go in and adjust my trend line. Okay, I'm going to remove my Ichimoku as well because it doesn't support our analysis. So you can see that we have quite a lot of bullish pressure here. So we can expect price. Let me just highlight this area as well. Okay, here. So my first support I mentioned is a pretty significant level with all of the swing highs and swing lows and price testing it many times. But I also have the 61.8 Fibonacci retracement and a 61.8 and let me take a look. Yeah, 61.8 Fibonacci projection. You can see this 3 points over there. So my 61.8 Fibonacci projection lines up nicely with my first support. So I can expect price to reverse off of our first support and within this ascending trend line. Okay, let me know if you guys have any other questions. Okay, if not, I think we can move on to our next chart. Let's go ahead and take a look at gold. Okay, so let's begin by looking at the higher time frames again. We have these three swing highs. Price looks like it's moving upwards here. On our daily time frame, price is pretty bullish as well. Okay, this is not a valid trend line, but I think we can all agree price's general trend is upwards. Next, 4 hours time frame. Okay, I have this trend line. Now let's go in with our support and resistance levels. Okay, so I have a support level here. Next, I have a resistance level here. But I'm not going to label this as my first resistance. I'm just going to call it an intermediate resistance because it's really close to where price is at currently. So I just want to keep that in mind. Okay, now. Okay, I try to pull it back as far as I can, but I'm cutting too many candlesticks over here. Okay, next, our second resistance here. Okay. So now let's go in with our Fibonacci levels again. So same thing for a retracement. I use these 5 levels. Okay, and I can see my 38.2 lines up and my 78.6 as well. So I'm just going to keep those two. Okay, next I'm going in with a Fibonacci projection. So for Fibonacci projection, we use these 3 levels, 100, 78.6, and 61.8. And okay, my 78.6 lines up with my first resistance. Okay, my 78.6 also lines up with my second resistance. Yeah, I think that's about it. Okay, now let's go in with some indicators again. So price is moving below the Ichimoku cloud. It's also giving us bearish on our MACD. Now let's take a look at RSI. Okay, once again, we have a pretty bullish divergence again. Okay, now let me take a look at stochastic as well. Okay, I'm gonna go ahead and remove our ascending trend line. Okay, here we have a descending trend line, and on our stochastic, we also have a descending trend line here. Okay, so I'm going to move my RSI, and 3 out of the 4 indicators that we've used tell us that it is a descending or it's a bearish momentum. Okay, so in this case, I can expect price to continue moving upwards towards this intermediate resistance, but there will be some resistance over here because of all of the downward pressure from the indicators as well as the descending trend line and also this 38.2 Fibonacci retracement. And as I mentioned earlier, this is a pullback area, resistance. So I can expect price to have some resistance here and maybe reverse off of it and head back towards our first support. Okay. So in this case, our take profit would then be at our first support, entry at our intermediate resistance, and then I'll place my first resistance as my stop loss. And as I mentioned earlier, I want to place it above, maybe slightly above over here, because this area here is a pretty big resistance area with all of the Fibonacci levels lining up nicely. Okay, I think I have time for one more chart. So if you guys have any requests, feel free to let me know. Okay, let's go ahead and take a look at DXY. Just really quickly, this will be our last one for the day. Okay, so same thing, let's take a look at the weekly time frame. Looks like price is moving downwards on our daily as well. Okay, it's moving in this descending trend line on our daily time frame. Okay, nope, trend line on our 4-hour time frame. So let's just go ahead and add some support and resistance levels. Okay, and then here is my first support. And my second support here. Okay, now let's go in with our Fibonacci levels. Okay, my 78.6 lines up. And let's go in with a projection. Okay, for projection, we use these three levels. So I'm just going to check. Okay, and price has surpassed our 61.8, so this is no longer valid even though it lines up with our first support, but our 100% lines up with our first resistance. So I'll be keeping that as well. Okay, so this is a significant area for us to take note of. Okay, I think that's it. So let's take a look at our indicators. Price is moving above the Ichimoku cloud. It's also giving us bullish on our MACD. Okay, RSI isn't really telling us much here. Okay, no. Okay. Let's maybe take a look at stochastic as well. Okay, stochastic is pretty bullish as well. Okay, so we can expect price to continue upwards and be attracted to our first resistance since there is such a major confluence area here. But we can also maybe expect it to reverse off and hit back down to our first support. So, but as of right now, it will be attracted to the first resistance, but it's not likely to pass such a large resistance area. Okay, that's all I have for you guys today. Let me know if you guys have any other questions. If not, I'll see you guys next week. I hope you guys found it helpful, and yeah, I'll see you guys next week and have a great rest of your week. Bye, guys. Bye. Thank you.